In 2023, the U.S. saw a record number of new businesses created, with 5.12 million new companies registered. The data for 2024 isn't out yet, but many expect another record to be broken. At the same time, every startup that even mentions artificial intelligence seems to attract billions in funding from eager investors. Yet there's a strange issue most people haven't noticed. There just aren't as many public companies anymore. Back in 1996, there were over 8,000 publicly listed companies in the U.S. Today, even with a much larger economy and far more capital, fewer than half of that number remain publicly traded. The reasons behind this shift are complex. Some point to private equity pushing businesses off Wall Street. Others blame the rise of corporate mergers or the decline in individual investors. But there's more going on. Major chains like Toys R Us and Bed Bath & Beyond have filed for bankruptcy. Some tech companies go public too early, while others grow so fast they dominate everything. Right now, just 7 companies, Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, and Tesla, make up over a third of the S&P 500's value. Add in Berkshire Hathaway, Broadcom, and Walmart, and 10 companies account for over half of the market. That's a big shift from 2015, when the top 10 made up just 16%. Even if there were more public companies, they wouldn't matter much. This extreme concentration is harmful, not only for investors, but for workers, customers, and even the big companies themselves. But to understand why, we need to dig deeper into how the financial system has changed. One major reason behind this shift is the growing power of private equity. These are firms that buy and manage companies without listing them on public markets like the NASDAQ or New York Stock Exchange. According to investment data, the amount of money managed by private equity firms in the U.S. has increased by over 1,200% since the year 2000. As a result, many businesses now avoid going public. The costs, regulations, and pressure from thousands of shareholders make public listings less attractive. It's easier for founders and early investors to deal with just a few big firms. Plus, many everyday investors don't invest directly in companies anymore. Most of their money goes into retirement accounts that are managed for them, and even those funds now invest in private equity. So public markets don't offer much advantage unless a company's already huge. Even when private equity firms want to sell their investments, they often sell to other, even bigger firms instead of taking them public. This keeps the number of public companies low. Since 2000, private equity has helped finance over 9,000 businesses. If those had gone public, we'd see a much healthier and more balanced stock market. But that's only part of the story. If the economy is now 3 times bigger than it was 30 years ago, we should have around 25,000 public companies. Instead, we have fewer than 4,000. And the ownership of these companies is becoming more concentrated too. Most major U.S. firms have the same top shareholders: BlackRock, State Street, and Vanguard. They aren't evil empires, but they control massive amounts of money on behalf of everyday investors. Their index funds make investing easy and cheap, but they also make competition weaker across industries. Because the same investors own shares in competing companies, real competition fades. Take airlines, for example. The largest shareholder in Delta, United, American, and Southwest is often the same: Vanguard. Together, these 4 control over 70% of the U.S. airline market. In the past, each airline would fight for passengers by offering better prices or service. But now their shared investors don't want them to compete too hard. If one airline wins, another loses. And since the same investors hold both, it's just profit shifting from one pocket to the other. So instead of improving, airlines cut costs, add more fees, and make things harder for travelers. And strangely, this situation isn't good for the investors either. Private equity, venture capital, and asset managers now take a large cut in the form of fees, commissions, and bonuses. The finance industry once made up just 3.5% of the U.S. economy. Today, it's over 10%. And the total value of assets they control has grown from under 50% of GDP in 1980 to over 180% today. These firms aren't too big to fail, they're just too big. Regulations that should protect the market haven't kept up. The last major company breakup by the government was AT&T in 1984. Since then, most punishments for anti-competitive behavior are just fines. Meanwhile, venture capital, which should help build new businesses, has shifted its strategy. Instead of funding innovation, It now focuses on building startups just to sell them to big tech companies. Real competition is avoided. Startups that could threaten a major player struggle to get funding. These areas are known as kill zones. As a result, fewer companies survive. Consumers pay more, workers have fewer options, and even investors get less value. This isn't just a trend, it's the great extinction of businesses. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.